Violence in Chicago. Plus, why I wish juror B29 had watched 12 Angry Men. And Harry Belafonte seeks to squash the beef with Jay-Z. But first, whose economy is it anyway? Good morning, I'm Melissa HarrisPerry. Okay, in case there was any doubt, I am not an economist. Here's what I do know about the economy. Last month, I was late on my credit card bill. I mean, it happens. But sure enough, this month, my interest rate went up a lot. So now, while I know this month my household will have an additional $200 deficit because of my late payment, it's hard to comprehend that while I may lose that amount of money in one day, Mark Zuckerberg, the dude from Facebook, he had his net worth go up by $3.7 billion in one day. This was after Facebook shares closed at a one-year high of more than $34 per share. Now, I don't know about you, but sometimes stuff like that makes me feel like I am living in a totally different economy. So what I want to know is who is in charge around here? Who is in charge of the economy, and who selects the individual that can influence how one person can make billions in one day while the other one has their credit card rates increase? First, the person who undoubtedly makes the selection is President Barack Obama, who was out this week like he was on the campaign trail, touting the need for continued vigilance in our economic recovery.
5 years after the start of that Great Recession, America has fought its way back. We fought our way back. I'm here to tell you today that we're not there yet. We all know that. We're not there yet. We've got more work to do.
All right. But who is going to do the work that the president spoke about and set the nation's economic course? That job will rest in the hands of the next Federal Reserve chairman, because to the extent that there's been an economic recovery, the Federal Reserve chairman is the person most responsible for setting the trajectory. It's not because the chairman has absolute power, but rather the ability to build a consensus among the Federal Reserve Board when it comes to controlling available money, the cost of money, and setting interest rates. Consensus building has mattered to our nation's economic policy long before the Federal Reserve System was even created in 1913 with the signing of the Federal Reserve Act by President Woodrow Wilson. That's because the Federal Reserve is the palace that Alex built. That's Alexander Hamilton, our nation's first Secretary of the Treasury, who was behind the creation of the first central bank. It was Hamilton who had the forethought to create a national bank that would provide credit and help stimulate the economy. That first bank would ultimately lead to a second, and then evolve into what is now known as our Federal Reserve System, which serves as the engine to our economy. And that is why the selection of the Federal Reserve Chairman is so important. And that is why you won't have to wait until next year's midterm elections for some good old D.C. palace intrigue. Because the speculation over who will be the next Fed chair is already on and cracking in the nation's capital. On Friday, a senior White House official made an announcement that spurred the speculation hounds into overdrive. Simply put, the official said that President Obama would not name a replacement for Federal Reserve Chairman Ben Bernanke until sometime in the fall. The intrigue. Yes, the debate over who will replace Bernanke has heated up. Will the next Federal Reserve Chairman be Lawrence Summers, former U.S. Treasury Secretary and President Obama's former chief economic policy advisor? Remember him? He was the guy who was the chief architect of the financial deregulation during the Clinton administration, which many progressives believe led to the 2008 crash. Or will President Obama make history and nominate Janet Yellen, who is already the Fed's vice chair and would be the first woman to hold the position of chair of the Federal Reserve? Yellen has the support of a handful of Democratic senators, including our buddy Elizabeth Warren of Massachusetts, who signed onto a letter on Friday urging the president to appoint Yellen. While Bernanke's term isn't over until January of 2014, he is expected to retire. But time is of the essence, because whomever President Obama nominates will have to be confirmed by, that's right, the Senate. And if history has taught us anything, it is that anyone who President Obama nominates to any position may not have the easiest time being confirmed. Yet our fragile economy doesn't have time for posturing and obstruction, so select is exactly what the president must do, because our collective economic future depends on it. At the table, Jared Bernstein, an MSNBC and CNBC contributor who is currently a fellow at the Center on Budget Policy and Priorities and was the former chief economist and economic policy advisor to Vice President Joe Biden. Democratic Congresswoman Barbara Lee of California, who is a member of both the House Budget and Appropriations Committees. Heather McGhee, the Vice President of Policy and Outreach at Demos, and Mark Calabria, who is Director of Financial Regulation Studies at the Cato Institute. So happy to have you all here.
Thank you.
Jared, I want to start with you in part because I can't believe this is the first time that you have come to Nerdland.
What took us so long?
I know. I have no idea why this hasn't happened before. But
I have a Nerdland carrying card.
So, and that's actually exactly why I want you here, because you're a very specific kind of nerd. Tell me, like, why, if I'm an ordinary person sitting at home on a Sunday morning having my coffee, why do I care who the Fed chairman is?
Well, first of all, let me congratulate you for actually making that introduction really exciting.
Okay, good.
Because the actions of the Federal Reserve have a tremendous impact on the economy that we all live in. Your framing was exactly right. Whose economy is it? And you gave a couple of examples of how the economy is working very well for a narrow slice at the top and not well at all for a lot of folks in between. One of the levers that the Federal Reserve controls is, kind of roughly speaking, setting the unemployment rate. Their task is to balance the unemployment rate, which they're supposed to keep as low as possible, and the inflation rate, which they're supposed to keep from growing too quickly.
Right, that's the dual mandate, right?
The dual mandate. And there's a trade-off, because as unemployment rates get very low, sometimes you can close output gaps and the economy starts growing quickly. That can put some pressure on prices. Historically, the Federal Reserve has overweighted the price part of the mandate and underweighted the jobs part of the mandate. Ben Bernanke's been very good on this. Janet Yellen's been very good on this. I actually think Larry Summers would be good on this as well. So it's very important that the Federal Reserve continues to target that unemployment rate as they've been.
Now, I feel like there must be folks watching who go, wait a minute, what? Set the unemployment rate, right? I mean,
roughly speaking.
Right, granted. And so I want you to give me a little bit more on that, because I do think that there is a sense, again, among laymen, that what you always want is for everybody to have full employment. And then you say, yeah, but then that has these other pressures. Talk to me a little bit about that.
Well, and let's be clear, what the Federal Reserve tries to do is manipulate the unemployment rate. Yep. They try to manipulate the interest rate. They try to do it very indirectly by trying to make credit available. So, you know, in a sense, I see it as the ultimate trickle down. We're going to lend to people because they're going to hire and invest, and that's going to, you know, create unemployment. It's very indirect. And in some cases, I don't think it's clear that that actually has a very large impact. It's not clear to me that all these rounds of quantitative easing, which have been buy-in of treasuries and Fannie and Freddie securities, have actually affected the employment market all that much. But I really do want to echo something Jared said. There's no more important, in my opinion, part of the government in terms of the economy than the Federal Reserve. What you borrow, you know, you mentioned earlier your credit card. Well, whether those credit card rates go up in the future is going to depend on the Federal Reserve. Let's not forget that it was 5 gentlemen sitting around a table who decided to spend over $1 trillion. They have $3.5 trillion balance sheet. Not even Congress could do that on their own without, you know, very difficult agreements. So tremendous amount of power in a small number of people. So who you get there absolutely makes a difference.
And so it's on exactly that issue that I want to come to you, Congresswoman, because again, if I'm a layman, I'm thinking, well, wait a minute, I don't get to elect these folks, right? And when you start talking about 5 people, 10 people sitting making these big decisions, then what I want to hear is that the folks I do have the ability to elect, the ones I can hold accountable, the ones whose names I know very closely, will be part of this process. And I got to tell you, I am nervous at this moment. All the things that we thought we understood about how Congress operated vis-a-vis the economy, that, okay, you're never going to get to a place where you don't let the debt ceiling, you know, increase, or, oh, we're never going to get to a place where we would just actually go into sequester. That's all been violated. Do I have any reason to fear that this Fed chairman nomination is going to turn into a fight on Capitol Hill?
Well, it could, and we've seen what has happened as a result of President Obama's election in terms of the obstructionist Congress. But I have to tell you, thank God we did re-elect President Obama, because the president has awesome power in making this recommendation for appointment. And I tell you, when you look at interest rates, it is so important to understand now, and let me give you an example, that the African-American community, as a result of the subprime crisis, our net worth now is approximately $5,600. And so we have to have a Fed Fed chair who understands, one, that they've got to focus on creating economic opportunities and reducing the unemployment rate, but also making sure that everyone has access to decent and low interest rates so that wealth accumulation and the ability to purchase a home is everywhere for everyone, that the American dream can be fulfilled, and right now it's not.
I want to underline what you've just said, Heather, because the president said something very, very similar this week in the New York Times that came out this morning. Probably folks are, sitting there with their coffee reading it at this point, in which the president says that the income gap is actually fraying our social fabric. He says that when unemployment is still too high and long-term unemployment is still too high and there's still weak demand in a lot of industries, I want a Fed chairman that can step back and look at that objectively and say, let's make sure we're growing the economy, but let's also keep an eye on inflation. And if it starts heating up, if the markets start frothing, let's make sure that we're not creating new bubbles. And this idea of sort of the responsibility not only to grow it, but to grow it equitably strikes me as a critical thing we all want to keep our eyes on as we move forward with this.
Yeah, when you ask about sort of who would ever want high unemployment, actually I think it's really important to unpack that, because there actually are forces who, and they've been dominant actually right until before the crash, inside the Fed, because you have to realize that actually the Fed is a very bank and Wall Street dominated institution. There are built-in conflicts of interest in terms of who becomes bank presidents. It's basically essentially chosen by member banks in each of the region. And so for Wall Street, inflation is the scariest thing to you because it lowers the value of your assets. Wall Street bankers tend to not be as affected by unemployment because they and their friends usually have jobs. And so that tension between inflation and unemployment is something that for a long time had very much been stacked on the inflation hawk side. This concern about economic inequality has to raise the issue of the other thing that the Fed does, which is actually it is an even stronger financial regulator than it was before the crash and before Dodd-Frank. And so the Fed could have stopped the subprime mortgage boom. It had actually the ability to regulate subprime mortgages and sat on its hands for a decade and a half because we had deregulators at the helm.
Yep, stay with us. We have so much more. We're going to talk more about this. And I also want to ask both of you about the art, the science, and the faith that is economics when we come back.